I'm Andy Kim, your finance professor at Current Topics in Finance. This is going to be my last lecture of the semester, and the next week you're going to see HK Choi coming to you, and then you're going to have a lot of fun talking about the hedge fund strategies, and then the new world will just unfold in front of you. Today, so we're going to prepare in terms of codings, R codings that's going to be useful in hedge fund world. As I said before, you came a long way, seriously. I know some of you, I mean, most of you are frustrated a lot. If you feel that you are frustrated and you feel that you are screwed in your midterm exam or whatever, it's okay because everybody is screwed together, right? If it is difficult for you, everybody else is feeling the same way, okay? So don't worry. And then also, as I said before, before midterm, it was more about corporate finance side of codings, right? Or big data or data management. If you are going to work for the private equity or venture capital and try to use some of the big data available to you, that's something you could do. Lasso regression to predict bankruptcy, to predict what? The M&As and all this kind of stuff, right? Accounting restatement. That's going to be useful. That's more of a cross-sectional analysis of accounting or the status of the companies, right? More of a static sense. And then it was not about the stock investment itself, but it was more about the long-term investment or the private equities perspective. Now, what we've been talking about since last week is more about the hedge fund perspective. There, you were taking the perspective of the asset managers, right? Asset managers trading stocks in quantitative trading wise. You will remember, Dr. Song Chang-hwan's special lecture. Also, this kind of quantitative trading, right? Long short strategies, and then size and book to market and momentum, and then we're going to talk about the quality investment today. That kind of things, right? We're going to buy and sell thousands of stocks, right? Thousands of stocks simultaneously, and then you'll have to think about rebalancing the portfolio every month or periodically, right? Thinking about the transaction cost, doing it, the quantitative trading strategy as an individual investor is almost impossible because you cannot buy and sell thousands of stocks. You're just hoping in, you're going to be buying and selling like less than 10 stocks, right, as an individual. But if you are working as a hedge fund manager, this is something you can do. So how can we do that? Well, we're going to talk about it like using R code. Last week, we talked about quantitative trading strategy basics, right? Pharma French three-factor models, right? And then for that purpose, I'm going to switch to another book called Quantitative Investment Portfolio Analytics in R by James Pizzerno. Some of you may question, Andy, do you want me to buy that book? And I say no. Because I manually typed almost all the wordings in the book for you in that R code that you're going to see today. Okay? I did it for you. No need to buy it. Don't spread it to other people. Okay? This is just for class purpose only. And then it has chapter 12. But I'm going to cover until chapter 5 only. So why? Because that is where we have to stop to be able to do some back testing and then Pharma French three-factor analysis, factor analysis kind of things, right? And there you can tip some part of the principal component analysis, so much so that if you apply that, you'll be able to do some sentiment index extraction if you get some data from Professor Vergler's website in New York University. Anyway, chapter 5. So it's going to be covered, and I typed up nicely for you. We can just scroll down and discuss it. And I'm going to talk about chapter 13. Chapter 13 of 이현열's book over here. Okay? 성과 평가 및 위험 평가. It's like a performance evaluation and risk evaluation by 이현열, Mr. 이현열's book. He is a PhD student at Hanyang University. He's a student of my friend, 강영구 교수님 over there, right? He worked for NH Amundi, one of the largest asset management company or hedge fund in Korea, and now he moved to another asset management house, right? Yeah, this is a wonderful book written in Korean, and then it's coding, and then the wordings are freely available on GitHub. So I'm going to take you there. Also, I typed up, okay, some of the wordings in English. I translated it in your R coding for you, okay? So no need to buy this book, okay? And you may wonder, chapter 13 seems like the end of the book. So much advanced stuff. How could you skip this part, Andy? The beginning part. You screw me up, Andy. No, it's okay, because all these parts in the beginning part, you already have those basic R knowledge ever since you studied with me since the beginning of this semester. We covered enough of codings, right? So you'll be ready. You are already in good shape already for that. Now, having said that, let's move on to coding number 1. I have about 6 different codes for you today. Last part of today's lecture will be event study, stock market event study. You remember that? Last class I told you testing market efficiency, and then i.e. testing your portfolio strategy, right? Whether you make money or not. Typically you do some cross-sectional analysis, right? Cross-sectional analysis of portfolio performance evaluation using whether your portfolio generates some positive alpha or not, right? That alpha concept, right? You test it that way, but that's more cross-sectional approach. More time series, right? More like time series approach is doing event study, stock market event study. That's going to be our last part. So I took some of the code available from Google, and then there was an Indian stock market event study. Okay, so this is global business administration. So why don't we study with Indian companies? Events, right? So wait for that. Now I'm going to open one file for our discussion. That's going to be lecture 9 demo 1 chapter 2 portfolio analysis. As you peek into this, you see 1 2 3 4 5 6 codes for today's discussion. So wait for that. Okay, portfolio analysis, a primer. So that's chapter 2 of this book. Okay. By the way, this is only page goes until page 120, so very short and manageable book for you as well. Now what do I do? All right, so I'm gonna shrink down like okay. So let's start by installing these packages and then library. Activate this library. The package of the day has to be performance analytics, and that's the R package specifically designed for portfolio backtesting and analysis, right? So makes your life very easy. So wait for that. So I'm gonna drink my water. All right. Already there. And then the wonderful thing about this performance analytics is that they have some data provided. Okay, as you download and install it, those data, basic ones, are uploaded for you. You just don't see it in the system. Okay, and I'm going to distribute the how do you say, the discussion materials for performance analytics. There's a, it's like a goes about, it's a, and how do you say, the explanation or all these kind of descriptions about this package is available in the Google. You can Google search performance analytics PDF, and then it's going to be a 300 pages long or something, right? Very long. I'm not going to ask you to master all those things, but just in case you want to explore further, you know, I'm going to share that for you. Anyway, the thing is, it has a data set called managers. So let's import that one. And then summary of this guy looks like this. Holy cow, what the heck is that? Well, this is essentially, you see S&P 500 index returns, right? And then 10-year US Treasury, 3 months US Treasury rates are there. And then, not only that, you have some other assets like ham 1, 2, 3, 4, 5, 6. I don't know, it's sausage or ham, or I don't care. But it's some hedge funds, asset management, right? Returns, right? And then EDEC, LSEQ, that's some of the hedge fund, another hedge fund associated with a French university, EDEC, right? So their performance is over here. Someday in the future, I hope we're gonna have SKKU hedge fund. Anyway, S&P 500 return, right? We extract from that. But before that, let me open up this manager's data set, because each time you download the data, you want to make sure you open up and then see how it looks like, right? Seeing is believing. Now, this data starts from 1996, January, and then it's a monthly frequency data. You can see it month by month, and then it goes until 2006 December. Okay, why does it stop there? Why does it start there? Don't ask me. It's just provided from that package. You see 10-year Treasury, and then S&P 500 TR, all these things, and then out of it, S&P 500 TR should be labeled, should be a vector over here, or but it says it's empty if I try to extract from it. Okay. Alternatively, you could write SP 500 RET like this. Okay. Wow. Now successfully it was imported. So I'm gonna change it to here. Okay. And then I will change it like this. So you can see one column vector matrix was created. S&P 500 returns, total return TR. Okay, the way I did it was designating the 8th column of manager's data. Summary, yes. What is that? Yes, minimum, maximum, and all these things. Let's analyze index history. Plot it. Yes. Like this. You can see those S&P 500 monthly index return, right? And then want to calculate what must have happened if you invested $1 in S&P 500 index at the beginning of the period, right? By the way, is this character too small for you to read? Can I change it, view, and then zoom in? Yes, I'm going to zoom in. Yes. Okay, hopefully it's going to be easier for you to read. Okay. Yes. Right, until here. Right, so this part tells you about what must have happened if you put $1 in that S&P 500 index at the beginning of the period and then wait until the, hold it until the end of the period like this. Yeah. So it goes, it's thinking about in terms of compounding, 복리계산 kind of things. Computing, come on, yeah. Cumulative product, right? Cum product. So that's what's happening. By the way, this thing is kind of screwing up our vision. So in the graph, so maybe I should zoom out a little bit. Yes. So by the time of the end of the period, your investment must have been more than doubled, even though there must have been some fluctuations significantly like this. Dot-com bubble and burst of it. That's what you're going to see after AI bubble and a burst of it. Anyway, so wait for that. By default, the starting value is 1 as above. However, you can set it to be $100, right? And then plot it like this, right? If it were $100, you must have ended with $260 or something by the end. And then to transfer the index to monthly returns, right? The TTR package is a handy tool. Index level, you got it, but you want to get the rate of return, right? Rate of change, ROC. That's not return on capital, but that's rate of change. Yes. So we install the library, so I don't need to run it over here. But S&P 500 return. Yeah, excuse me. I'm sorry. I know. And then we create a data.test over here, right? That's nothing but managers S&P 500 and then S&P 500 red to see these are identical, right? Whether you just directly get the return data or you construct the index level based on that returns and then backsolve for those returns, you'll get the same result. As for return, we can easily create a performance data for different rolling periods using the monthly numbers in S&P 500 index. Generating rolling 1-year returns is simply a matter of changing the period arguments in the ROC to 12. So, yeah, 12 months return, right? S&P 500 12 months return is calculated using this N12, right? And discrete, right? Gives you this, tells the machine to calculate this return in a simple adding way. Okay. Oh, not a simple adding way, but discrete compounding, as opposed to continuous compounding. So discrete compounding is like period by period compounding, as you've seen before, right? Continuous compounding is like using natural log. Like every second you are compounding it. And over 12 months period, right? Natural log of it will be doing it. But anyway, here we are doing it in a discrete way. So that's this guy, 12 months. We created a vector like this. Now you see 23%, 26% like this going on. Huge number because this is yearly, right? Rolling window, yearly returns are calculated. Let's plot multivariate data sets, right? And matplot, graphing, multiple time series, we'll be doing it. So matplot, I take it as like matrix plot, right? Not just plotting one time series, but you're plotting a whole columns, like multiple columns or matrix of time series to visualize. Let's put 2 time series from the manager's file, the monthly return for the S&P 500 and the 10-year US Treasury note, right? So let's do it like this. You see that 2 time series chart going on in one chart, right? Red dashed line, which is US Treasury, and black solid line, that is S&P 500 index returns. Yes. Now let's move down to risk metrics, right? Once you have a portfolio, you want to understand the risk of it. Okay, of course, in risk, in pure setting, risk has upside and downside risk, right? Being good, 대박, being 쪽박 or bad, risk covers both ways. It's double-edged sword. But over here, it's going to be more focused on the downside risk. That what happens if it is screwed? Okay, that kind of thing is going on. Risk metrics. Many imperfect metrics of risk exist. No perfect one exists. So we are trying to take an evidence from here to there and see if it is commonly pointing to the same direction. Okay, no metric is perfect in the world. Okay, it's like a detective. Okay, detective trying to identify who is the killer. 형사가, right? Who is the killer? And no evidence is perfect. Okay, there is always a room for a mistake. You remember that confusion matrix, right? Type 1 error, type 2 errors. So this detective will always bring multiple evidence and say, oh, this evidence tells that you are the culprit, right? And then evidence number 2, you are the culprit. Number 3, you are the culprit. So based on this multiple the evidence, multiple pieces of evidence, we conclude that you are the murderer, kind of things, right? So risk metric is the same thing, right? No metric is perfect, but let's bring in one after another and then see the downside risk of it. Yeah, base package offers numerous possibilities of slicing and dicing financial risk. Consider volatility and correlation, the building blocks of modern portfolio theory, MPT, right? Use apply to run SD on each column, right? Each column. Yes. And then data, start from this, and then we're going to create a vol matrix, okay, based on 8th and 9th column of managers, right? Vol, this is going to be a vector like this, not a matrix. Anyway, notice these are monthly return volatilities, right? Volatilities because it said SD, standard deviation function, in this apply function over here. And then if you want to show it in annualized return volatilities, this is monthly return volatilities every month over here. No, not on a rolling basis, but monthly return volatility over here. Okay, so the first time series 4.33%, and then second time series 2.04% volatility, right? Monthly return volatility. But you want to compute annualized volatility, then what do? Well, multiply this guy by square root of 12 because volatility is a standard deviation, which is a square root of variance, right? So the period number 12 should be the square rooted like this. So vol annualized square root, yeah. So you see that result coming up like this. Square root of 12 times this guy should be 15% like this. You remember variance has no unit because it's a unit squared, but standard deviation has a unit, valid unit, percentage like this. So 0.15 tells me that this is safely, 15%. And US Treasury, 7%. Okay, rolling annualized volatility, roll apply, offers a solution for a 12-month window. Set the width argument to 12 when using monthly returns. Note the use of NA omit to remove the NAs not available, missing values, right? So drop all those things and then commonly start with all the observations with all the variables with non-missing values only. Okay, that's NA omit, right? So if you run it, it will look like this, right? And then correlation coefficient between these two, well, those look like this. S&P 500 and then US Treasury, right? Negative 16% or 0.16, right? That's correlation matrix. And then Pearson correlation is shown, okay? And digit wise, you want to trim it, or not trim it, but round it up, okay, at third digit below decimal point, right? That's digit 3 command over here. Pearson correlation may change over time, right? These two assets may correlate, the correlation of these two assets may change over time. So rolling window correlation, how do we construct that? Well, 12 months correlation, month by month, and then we roll down. Core roll will be created like this. That's this matrix, right? Correlation, it captures the dynamically changing correlation of these two assets, right? Going until December 31st of 2006, end of the period. And then notice that it starts from the end of 1996 instead of the beginning of 1996 because we are computing the correlation over the trailing 12 months, right? So January until December, that correlation goes into December correlation. That's it. Now, plot this correlation. Yeah, it looks like this. Interestingly, depending on the time period, that market index goes sometimes together with the risk-free asset, sometimes to the opposite. Back and forth, back and forth. Anyway, volatility and sharp sharp ratio. What did I write it over here? Sharp ratio. Okay, standard deviation already there for you. Okay, is already there for you to compute volatility. Risk is all about volatility, but there is something more to risk that we want. Okay. First of all, the systematic risk and then idiosyncratic risk, beta kind of concept. We're going to go there. And then, if you remember CAPM, there was something called Sharpe ratio. What was that about? Well, it was the excess return of the portfolio divided by the risk of the portfolio. For a given unit of risk, 1% more of a risk, how much of an excess return does this portfolio generate for you? That's the concept of Sharpe ratio. For a given unit of risk, you want more return. I want more and more and more returns, right? But excess return, excess of what? Risk-free rate. So you want to subtract the risk-free rate when you compute the numerator. You're going to get there later on. But the denominator has to be the volatility of the portfolio. That's Sharpe ratio. Okay. And then provides STDV, which eliminates the outliers in a data set to minimize. Okay. Standard deviations, STDV, automatically trims off those extreme values, right? Outliers. Extreme values to influence the result via Geltner methodology, right? And then compare the dirty output versus clean the results. Okay, so cleaned ones use STDV and dirty results use SD, standard deviation over there. Out of the data, create a return matrix, return vector, and then round, okay? Like this. Standard deviation. Yeah, what is this command? Compute the standard deviation of the returns and then round it at the 5th digit below decimal points. That's this command. And then standard deviation. And this one is calculated. Clean C Geltner, right? This is Geltner, a function that trims down those extreme values, right? And then round like this. Yes. Annualize the standard deviation. Did I say STDV automatically cleans up the extreme value? No, I'm sorry. I was mistaken. You should specify clean like this, okay, explicitly to eliminate those outliers, right? STDV does not. So you see that dirty number and then cleaned number. Oh, dirty number versus cleaned number over here, the contrast over here. Okay, and then annualized means, right, square root of 12 is multiplied. Okay, now we move down to Sharpe ratio, the value of comparing assets and portfolio performance on a level playing field, adjusting the returns for risk. Okay, the rewards to variability measure. Sharpe ratio should be, you remember, return of the portfolio minus risk-free rate divided by the volatility of the return of the portfolio. Okay, and then higher Sharpe ratios reflect higher risk-adjusted returns, more bang for a buck, right? And then portfolio with superior strategy. So you want your portfolio to deliver higher Sharpe ratio than lower Sharpe ratio. Okay, it's a way to tell your investment idea being good or bad. Okay, automatically annualized Sharpe ratio is obtained through the following code. Round up the Sharpe ratio annualized, right? Return of this S&P 500 and risk-free. Risk-free rate is designated over here. Risk-free rate specified. Let's say the risk-free rate is 1% per annum, but monthly risk-free rate has to be divided by 12 of it, right? So that's why 1% divided by 12, that should be monthly risk-free rate. We just explicitly give the risk-free rate like this, okay? And then return should be S&P 500, and then annualized Sharpe ratio is what? 0.5373, okay? Very high. That's good. And then notice RF used here is monthly RF. More for daily returns, the scaling takes the form. RF should be divided by 252, assuming 252 trading days in a year. Okay. Of course, you know, depending on the calendar year, some trading day, some years you're gonna have more than 252, but it's not such a big deal. Okay. Maybe I'm too much academician, but let's see. Sorting ratio is a popular alternative for Sortino, not a sorting ratio. Sortino ratio. This is a popular alternative for Sharpe ratio. It focuses on the downside deviation. I'm sorry, copying down those wordings from that, you know, in a hurry makes a lot of typos. But returns for measuring risk. Okay, and then this is in contrast to Sharpe ratio's reliance on standard deviation with no distinction between the upside and downside risk. Sortino ratio is defined like this: return of your portfolio minus MAR divided by sigma of MAR. What the heck is MAR? That's minimum acceptable return threshold. Okay, sigma MAR is a downside deviation. Okay, downside deviation. So Sortino ratio return, and then it will look like this. Okay, MAR is assumed to be 0%. Okay, tolerance to be 0. Okay, yeah, and then beta. Okay, market beta that we used to talk about. Yes, market risk is measured with it. Covariance of assets return relative to the variance of the market portfolio returns. Let's compute the beta for the EDEC long short equity hedge fund index via the manager's file using the S&P 500 as a benchmark. Now, if you're wondering what EDEC, the benchmark, is about, you can explore this website. And then you must see Frank Favosi coming up over there. That famous professor of fixed income. Yes. Textbook. Now, cap and beta is computed like this, right? EDEX portfolio, okay? Based on, what is that? Yeah, and return benchmark is S&P 500, and then the return that we are interested in is EDEX portfolio. Okay, its beta is 0.3355, right? Cap and beta. Yeah. Okay. Value at risk, okay, is one famous concept that you want to master, right? This is a probabilistic summary of the typical extreme loss potential for assets or portfolio. The potential for an asset or portfolio's price moving before than more than right, price moving more than 2 standard deviation relative to the current price over specified time period. Okay, so the flaw of it is tendency to underestimate the worst case scenario. Let's see. For the way I understand the VAR is start with normal distribution bell curve, okay, of your portfolio. Okay, there will be a return distribution following normal distribution, right? The return distribution, and then there must be mean, average, and then 1 standard deviation, 2 standard deviation, okay? And then what's the tail risk over here, okay? And then in case of this kind of worst things happen, what's going to be your loss, right? Dollar value of loss once this kind of tail bad event happens, right? That's VAR, value at risk. And then you want to estimate the probability mass, okay, the probability of this tail risk. And then so that's that, value at risk. The flaw, yeah, is that theoretically, who says the distribution of the return should be normal, Gaussian, right? As it turns out, the return distribution is more fat-tailed than Gaussian distribution. But then again, why do people use Gaussian distribution or normal distribution to do value at risk and all these kind of financial exercises? Because it's mathematically tractable. You can follow and then formulate more efficient, not efficiently, but more handy, not handy, but Gaussian distribution has nice mathematical formula that you can work out nicely. Okay, you can apply it to any other mathematical models without significant troubles. It's differentiable. You can integrate those things very easily. Okay. Second derivatives, third derivatives, all these kind of things are available for you. Okay? Whereas those fat tail distributions like Pareto distribution or Weibull distribution, all these kind of things are not mathematically tractable, so that even the engineers have a hard time inputting into and then sticking into other economic models to work out. So that's why they stick to this Gaussian distribution. Understanding with the caveat that there is a fat tailedness of the actual distribution, so that we have to be careful about. So that's one explicit flaw that you have to recognize. Tendency to underestimate the worst case scenarios, fat tail problem of black swan. Still, it is the staple in financial risk management. Number 1, theoretical properties is analytically manageable. Number 2, implementing is easy. Number 3, easy of back testing. Yes. VAR comes from 3 basic varieties. Number 1, parametric. Number 2, simulated. And number 3, historical VAR. Right, comes in 3 basic varieties like that. So we're going to focus on the historical VAR, which is using our historical data. What must have been the tail risk, okay, in our back testing, right? I'm not going to ask more than that. You can explore for simulated ones or parametric ones if you go into more advanced study. The computational engine is statistical distribution for estimating the potential for loss, right? Based on 2 parameters, the average return for the time series under scrutiny and the standard deviation volatility of the return, which can be derived from the historical record of the forecast. Wow. By the way, one thing I forgot to mention is that the Gaussian distribution, right? Another reason that we stick to Gaussian distribution is you can be summarized by 2 parameters only. You need just the 2 inputs. One is mu, the average. The other is sigma, the standard deviation of it. Remember normal distribution, mu, and sigma. This is Gaussian distribution. You need only 2 inputs. As long as you know the mean and the standard deviation, the rest of it, no worries, baby. Yeah, the life is easy in Gaussian distribution. You can pretty much, everything fits in over there. That's one important reason why people stick to Gaussian distribution. Weibull distribution or other Poisson distribution, whatever distribution that you learned in the those advanced statistics, good luck, right? You need a lot more input. And then for processing the data, a normal distribution is the standard choice, although a number of alternative possibilities exist as well. Keep in mind that VAR calculations are based on a confidence level, with 95 percentile and the 99 percentile being the most popular options. Another reason, VAR is popular is that it goes together with your learning in your statistics 101. Okay? Quantile function is there for you. Q norm, quantile of normal distribution. Yes. Mean is specified like this. Standard deviation is specified like this. And give me the quantile of 5 percentile. And that's this guy. Okay, if the return mean is this, and return standard deviation is that, then by the time you have minus 9.44% return, you can tell that you are at the tail, a 5% tail there. Screwed. Anyway, cumulative distribution function is also there. Quantile, right? P norm, probability of normal distribution, right? Okay, so it is the inverse of it. You input those return minus 9.448% return, okay, decimal format, right? You input it as Q, and then you can generate the probability of having this kind of return or worse, which is 5%. We can also run a VAR on multiple probabilities simultaneously. Here's how VAR stacks up at the 95% and 99% and then the 99.9%. So Q norm, okay, mean and standard deviations specified, but here we want to get a matrix of result, okay, a vector, because we specify the quantile 5%, 1%, 10.1% quantile specified in C over here, right? C that specifies a vector. Instead of a scalar, instead of a number, we specify 3 different values over there, and then it spits out 3 different returns, right? So it tells us that minus 9.44% return, that's 5 percentile return. Minus 16% return, that's 1% chance of having it. How about, excuse me, how about 23% or 24% minus return? Well, the chance of having such a miserable return is 0.1% chance, right? Extreme screwed up situation. Anyway, for simulated VAR, the R norm function can be used to create a synthetic data that mimics a set of normally distributed returns. Let's generate a 10,000 returns with a mean of 7% and a 10% standard deviation, and then estimate VAR 95, 99, and 99.9 with a quantile function. By the way, VAR is a concept frequently asked in CFA exam as well as financial risk managers, right? Oh, did I say I'm not going to ask you about simulated VAR? No, I give you over here, right? So you can generate it by simulating 10,000 times. So that's that. The simulated results for VAR are very close to the output using the Q-norm function above. Why? Because in both cases, the specified mean and standard deviations are the same. For historical VAR, the focus turns to analyzing the actual returns for a particular same sample period. So the previous one, the initial VAR, was based on our parameters, right? Did I say I'm not going to ask you about the parameterized VAR? No, I'm going to ask you. I'm sorry about that. Simulated VAR, I'm going to ask you again, right? Historical VAR, it's just, based on the historical data, right? Generate the distribution, the histogram, you have it. You can compute the probability mass depending on the quantile that you specify. That's what's going on, right? Sample period as an illustration. Let's use the manager's S&P 500 return in the data set. In practice, a longer history is recommended with a data set in hand. Fitting the history, historical VAR 95 is a simple matter of locating the return at the 5th percentile. The quantile function does the work for you. Okay, so based on it, quantile function tells S&P 500 index return 5%. What's the return? What's the S&P 500's return historically that shows the 5% tile of a miserable return? The tail returned, right? It says minus 6.69% return. That's historically 5 percentile of performance, right? The left tail, you see it in your picture over there. Anyway, so that's this. How about 5 percentile return for US Treasury? That's minus 2.5%. Okay, by investing in those US Treasury, okay, in reality, you can realize negative return, right? Holding period return can be negative like this. When the interest rate goes up, the price of the bond goes down, so that you lose money. We can visually inspect VAR 95 in the context of the full data set with a cumulative distribution graph. One possibility is sorting the returns and instructing R to identify that 5% quantile with a dotted horizontal line via the 1ty equals 2 command using abline function. Note sorted returns are initially transformed to a numeric file, which is required for charting in the case in order to ignore the out of sequence dates that result from ranking the returns from large to small. So it looks like this, S&P sorting, and then plot this, guys. Yes, like this, right? 5% return, that you see it, visualizing the VAR. Limitation of VAR, yes, this is self-explanatory. Shortfall risk is another risk measure. Consider the estimated probability that a return will fall below a specified threshold. What is the probability that the S&P 500's monthly performance will be negative? Well, it depends on the distribution assumption. Using the manager's S&P 500 TR sample for 1996 to 2006 and assuming a normal distribution, the estimate is simply a matter of running the cumulative distribution function CDF with the appropriate parameters like this. Okay, 42% chance. Estimating the probability that the return will be positive, you will be switching this into false like this. You add these two guys, that will be adding up to 1, adding up to unity. Yes, the estimated probability for negative and positive returns sum up to be 1 like this. Okay. Drawdown is another measure of risk. Peak to trough declines for the securities and portfolios is here. Measuring the risk through this lens offers the empirical profile of history and provides a rough estimate for what to expect in the future. When red ink returns, right? 적자 returns. If asset A has suffered a 10% drawdown, asset B's drawdown is 5%. It's reasonable to say that A is twice as risky as B. To generate the top 3 drawdowns for the manager's S&P 500 returns, use this function table drawdowns, and it shows you the period of the longest period of drawdowns, like in the underwater, right? When it is taking the longest duration of underwaterness, you can see it over here. The period from this to that, right? Must have been the drawdown period, longest one. The graph of drawdown through time. We can use the drawdowns command in the time series library. To use drawdowns it's necessary to transform manager S&P 500 TR to a time series object. Once the DD data is collected in the DD history file, it's easy to generate a chart. So for that part, install a package called time series, and in library, you activate that guy, right? And then plot that result. Okay, the result will show like the following. Okay, so drawdown starting from when the index is underwater, right? And then start going down and then recovering. Okay, you can see that downside risk visualized. All right, thanks for watching.